Hey there, welcome to the SaaS Unbound podcast. I'm Tim Schumacher, your host today, joining for a special series where I chat with M&A experts about all things SaaS acquisitions. I'm the founder of SaaS Group, a serial acquirer buying wonderful SaaS businesses to take them to the next level. And my guest today is Pascal, the CEO at Noosa Labs, buying and nurturing small SaaS businesses. So Pascal, that sounds very similar to SaaS Group, which is great. Can you explain a little bit what Noosa Labs does, and also where you might be different to what we are doing?
Yeah. So I think both Noosa Labs and SaaS Group like to buy mostly bootstrap SaaS businesses all around the world. I think that there are two major differences, I would say, between what SaaS Group buys and what Noosa Labs buys. SaaS Group buys more, I would say, small SaaS companies that are doing $1 million in ARR or more, like 1 to 10, where typically you have more of a team, a company with an org chart. We buy mostly small bootstrap SaaS businesses that are doing 200 to 800K of ARR that typically don't really have a team. There's maybe a founder or two, a few freelancers, maybe some support people abroad, but it's really very minimal structure. And so the companies that we buy tend to be more organic with more product-led growth and very profitable, but small. And so they are typically, I would say, more profitable, but also much smaller than what SaaS Group would look at. I mean, obviously, if a company
Yeah.
is very profitable, you don't mind. But I would say that it seems to me from what I've seen is that you're building more real
Yes.
companies, whereas
No,
for me
that's
it's
correct.
a bit different.
That's correct. We start at 1 million ARR. We sometimes have similar profiles. We bought companies where there's one developer doing over 2 million in revenue, but that's the exception, not the rule. And it
Yeah.
seems like you buy them at an earlier stage, 200 to 800K. It seems so. Founders have to have found product market fit, but at an earlier stage, and very often are alone plus a few freelancers. That seems to describe the profile.
Yeah.
And one or two more personal questions before we dive into the M&A market and some of the trends we're seeing. How did you get to do what you're doing today? Like, what was your entrepreneurial journey? Maybe really quick
Yeah.
to focus on this niche.
Yeah. I mean, I've done 20 years in tech. So I started my career in 2003. I wanted to be in tech. Being in tech in 2003 was not very common. I mean, as you know, you started a little bit earlier, but it was not mainstream then. I've been a founder a few times. I've been an executive a few times in companies, one of which was acquired by Yahoo, one of which is now a very large, like 9-figure revenue SaaS business. And one thing that I've realized is that I'm actually quite good. I'm not amazing at 0 to 1. I'm quite good at taking something that kind of works and bringing it to the next level, and I like it. And on the other hand, I did,
Sorry to interrupt, but it's
yeah,
very interesting because I say sometimes exactly the same sentence. I'm not a 0 to 1 guy. I'm a 1 to 10 guy. But it's interesting that you're saying that because I'm using the same
yeah.
analogy.
And I mean, I think that to be a great 0 to 1 person, you need to be completely obsessed with a problem. And I'm more of a generalist. I mean, one area I've been quite successful was as an investor. I've been an angel investor. I lived in San Francisco for 12 years and I angel invested in many companies, like 120, 130 companies. I mean, invested in Notion, Checker, which is a company that I joined, and quite a few other companies that will become public companies in the end. And so I like the investing part because I like the variety. But what I didn't like about investing was that you were never really in the weeds, and
Yeah.
that also I had a lot of FOMO because it's kind of basically a few investments per year define your results. And in many ways, what I like about, and so I discovered when I was at Checker, I was doing partnership with vertical SaaS businesses in the US, and I discovered Constellation Software that way. I never heard of them. And then I became fascinated by their model and read about them. And nobody in Silicon Valley was talking about them at the time.
Yeah.
Or
And they're the second biggest tech company of Canada,
yeah,
only followed with a very small margin after
Shopify.
Shopify,
Yeah,
which
yeah,
everybody knows.
yeah,
But it's interesting that you're saying that, because I've been watching exactly the same things. People do not know Constellation software, and I
yeah,
find them extremely impressive.
yeah. And so I read about them. And I said, okay, this. I thought initially I wanted to do something a little bit like them, but with fintech, so a little bit like Shopify. Eventually I talked to a lot of companies in Europe to do that. To and then the price tag were much higher. The Like, it was hard. It would have been hard for me to raise the money to be able to do what I wanted to do the way I wanted to do it. And so I decided to buy something smaller, so that I could own it and not worry about investments and stuff like that. And so that's why I chose the niche that I chose,
Mm, cool.
something where I could do it on my own initially, at least, and go from
Yeah.
there.
Cool. No, totally get this. I mean, it's interesting while you're saying that it's so many similarities to how I explain SaaS Group. Also, this feeling as an angel investor, while we both seem to love this, I do this on the side as well. That feeling of shaping things, which I think most of our listeners will appreciate, because most of our listeners are builders as well. They like to build things, and investing is you only always stay on the surface. It's fun too. You meet great people. You learn a lot about new technologies, but it's you always stay on the surface.
Yeah,
And so it seems like we're builders at heart, just like the people whom we buy businesses from. Just
yeah,
that we build at a little bit later stage. So the 1 to 10, not the 0 to 1 game. And so
yeah.
what do you do with the businesses at Noosa Lab? Do you want to continue them forever, like Constellation or SaaS Group, or do you want to sell them again?
Yeah, I mean, we want to keep them forever. I take selling as a failure. I mean, basically, selling for us would happen in two circumstances. We've made some, I would say, less good acquisitions, to be honest. Not all
Yeah, we
acquisitions.
all do.
And when it's the case, because of the way we finance what we buy, I mean, so we buy with a combination of my equity, the money that I invested in the company, the cash flow of the business, and then some debt. And the debt we have is fairly high. The interest rate is quite high, and it's not very
Mm,
forgiving.
yeah.
And so when we realize that we might be at risk, we prefer to sell, cut our
Okay.
loss, and move forward and move on. And we've done that once already, and we're actually in the middle of doing that for another asset.
Okay.
But typically, we don't want to sell, and if we sold, it would be because somebody is offering us a price that we can't refuse. Like
Yeah.
if you're
Yeah.
offering
With a
me,
strategic premium.
yeah, like yeah, a strategic premium that allows me to buy even more. Sure, I'm willing to entertain the idea. But if you're buying the same price, like same multiple that I bought it at, I don't. I'd rather
Mm,
keep the cash and keep growing the
right.
business.
Right. Well, unless you were able to improve the revenue or the profitability massively during your time,
Yeah,
so you've captured a lot of the upside. But no, I think we think about it very similar. Again, at SaaS Group, we like to hold companies forever, but there are cases where we might not be the best owner, or where business we had that once a business has become too small, and we felt it was better positioned with someone who really strategically values that. So it seems like, again, we're thinking very much alike. So that's the sales part, or the continuation part. But what is how do you determine which companies you're after when you buy them? So shifting a little bit to the buy side,
yeah,
what companies do you buy in terms of the topics? You talked about the size, but also topics, geography. What are the companies you're after?
yeah. I mean, so in terms of topics, we are pretty agnostic, to be honest. The first business we bought were a lot in the marketing, like customer lifecycle space, just because there are lots of companies in that category that happen to be small and bootstrapped and profitable. But we recently bought an HR tech business in Latin America, so very different. I would say that I like the Latin American market, and I'm actually looking to buy more things there, especially in HR, just because we have one asset, and I think that it would be good to have more. And I'm starting to understand the culture there more. And a lot of my team is actually Spanish speaking. I'm actually one of the two
Oh,
or three members of my team who's not Spanish speaking. So
okay.
I might soon need to do more Duolingo stuff. So HR tech is a space that I worked in for 4 years, and I understand. And many people don't like it, and I actually like it for that reason. Also because I understand the culture of HR teams, because I've again done a lot of partnership there in the US. And so I understand that space a bit better than the average SaaS buyer. I like, but we've taken a look at marketing SaaS, DevOps, dev tools. What is really important for me when I look at a business is, first of all, it's profitability, which typically means that there is a cheap way of acquiring customers. And so I like businesses that have a fair amount of customers. Some of them might be free users, and then some paid users. And the second thing that we look at is businesses that despite all these things are able to attract large companies. So if you're a product-led growth product, but you still have names when I go to Stripe or whatever that I recognize, that's a good thing, because it means
Because
that,
then you know that you can sell into those and they can become really large customers, and that initial sign up is just the beginning, or for what reason?
yeah, I mean that's one of the major reason. The second one is that typically large companies, they do research when they do look for tools, and so if you have good logos using you, it typically means that you have a good product. So from the outset, you don't really know when you look at a
Yeah.
business
So
which
you're
one.
saying you're using it as a proxy for real product market fit,
Yes.
the fact that they
Yeah.
have signed this up.
Yeah.
Okay.
Yeah. And that you're the
Okay.
leader and you're not used because it's cheap. What I don't
Okay.
want is to, like, what you don't want is to have a bunch of customers that are buying you because you're the cheap knockoff, but and what I like is when you can be, maybe you're cheaper than the others, but you have customers that like you because you're the good product, not the cheap product.
Not the cheapest. No, I understand that. And what affects valuation? I mean, I'm sure all of those, but many of those factors you just named. What is for you? What are the core things then actually affecting the valuations of the company you buy?
Yeah.
Anything specific there you're looking at?
Yeah. I mean, in terms of valuation, we initially, obviously, buy sellers, they're thinking in terms of multiple of ARR, because that's how they've been raised in a way, like a podcast, blog post,
Mhm.
VCs, analysts, they're talking about multiple of ARR.
True.
Obviously, that's the language they want to hear. That's not necessarily how I think about it personally. I mean, at the end of the day, for a company like ours, we're buying profits and cash flows. And so I'm always thinking in terms of multiple of, as what we call SDE. So ARR, like the revenue minus the operational cost, but not the salary of a founder or the dividends or the training of a founder or his office space or whatever the founder needs to run his business, but we don't have to run, because typically in our case, because the business is small compared to you guys, the founder wants to move on. He sells because he wants to move on,
Mm.
not because it's a different mindset, I would say, in his or her case. And so we look at that. And so what changes that? Well, I mean, frankly, it's a question of profitability. I mean, because we need to find a bridge between the multiple we look at and the multiple that the founder will look at, which is a multiple of AR. So what drives the multiple, obviously, is, from a seller standpoint, is the profitability. If you're very profitable, like 90% margin, then obviously it's different than if you're 60% margin. Like, your ARR multiple, I can pay more. The second thing is growth. If you're like sub 10% growth, like 0 to 10%, it's a very different story, even if you're like 40 plus growth percent a year. We don't typically look at businesses that are growing very, very fast, like 60% plus. They tend to be very expensive and sometimes for good reasons. But I mean, typically we know we can't really win these deals because the price is too high for us. And then we look at churn. We are not as religious on churn as others, meaning that what we care about, like we have businesses that have a decent churn, but they have such a huge amount of inbound every day that it's okay, but we can still grow at a good rate despite the churn. But obviously, if you have a business that churns at like 30% per month, it's going to be less expensive than a business that churns at 5% or per
Right.
month. We don't have too much negative churn in the business we bought, even though for one of the business we bought, we have a little bit of that, but for HR Tech one. But yeah, I mean, for us, it's really about churn. It's about growth and profitability. These are the three most important metrics that determine valuation for us.
Okay, good. Good. No, thank you. That's helpful. And so maybe shifting a little bit to the sourcing part. How do you source companies and kind of like what's, how do you build relationships? Do you use marketplaces? How do you go about in actually finding the people who ultimately want to sell to you?
Yeah. So I wouldn't say that we have solved this problem yet, to be honest. So what we
I guess
did
we all don't have. I mean,
yeah,
we all could
yeah,
could get more leads. There are
yeah,
millions of or millions, not millions, but probably hundreds of thousands of those companies out there. But
yeah, yeah,
it's still interesting to hear kind of
yeah, yeah.
the ways you go about. And it's I think it's also because we have a lot of founders listening. They want to know how they can contact you, or also like what marketplaces should they list on, those sorts of things. So a little bit
Yeah,
taking also the founder
yeah, yeah, of
perspective
course.
of.
I'm in like, disclosure. I'm a small angel investor in a company called Acquire.com. I was
Ah,
one
cool.
of their
Yeah, we
first.
all know them. We love
Yeah,
them.
yeah. I
Yeah.
was one of their first user, one of their first paid subscriber, and I would say that initially I was looking almost exclusively on Acquire.com, then discovered other brokers like FE International and a few like Flipa and a few others. And so I look at all these marketplaces today, and I have built connections with some brokers that don't necessarily list on marketplaces, but just have a network. So I'm connected to brokers in Spain or in Latin America because of my American acquisition. Also in with brokers in France and others. So that's one angle. I started publishing more on LinkedIn at the beginning of the year. That's why Dirk and I have been closer. Dirk from your team, he makes jokes on my post, and I make jokes on his.
You,
Uh,
yeah.
and
That's the secret sourcing sources
yeah,
jokes.
and so that's one thing that I also do, and we're going to do way more there. I have, and I'm in next. Like in the coming months, we're going to do way more things. I'm working on more things on the content side, like more outbound, because there are lots of people that are flagging in a way. Many bootstrap founders, they like to flex their muscles and show their MRR on Twitter or on indie
Yeah.
hackers and stuff like that, and so we can reach out to some of them more often to see whether there's an opportunity for us to at least get to know them, and when the time comes, be able to make a move. I mean, at the end of the day, I think that if you're playing this game for a long time, what matters is that people know who you are and trust you. And I think that's really what we want. We want to have a good reputation in the marketplace, not screw people around,
Yeah,
and
you always
be
win
there.
twice. I
Yeah,
can wholeheartedly agree.
yeah,
Like you want to build a proper reputation in the market as a trustworthy partners. I mean, especially in the acquisition space, I feel that there are also a lot of people who are not genuine. For example, they don't have the money. They enter into an agreement, and then they have to search for the money. As we all know, that often fails. or those sorts of games, or they're really just going into a DD with the hope of then later massively slashing the price for really no reason, and those sorts of games, and that bites you in the long run.
Yeah.
I fully agree. Yeah, no, seems like it's very interesting.
I,
Seems like
I
we're
often say that I'm the man. I'm sometimes, for some opportunities, I'm the man with a bouquet at the altar, waiting with a ring in hand, and I know that the bride will come back when she'll be deceived by this other buyer who promised crazy price and that they can't actually fund. And I'll be there, and I have a wedding ready.
yeah,
Uh,
true. No, and sometimes that happens. We've seen deals come back, but also we sometimes see that there are other people who pay other prices, or they are able to lure founders into that or play other tricks, and then you lose a deal. I think that's
yeah, yeah, that's part of the game. Yeah.
part of the game. Yeah. Two more questions. Maybe one still kind of on the acquisition stage before we kind of finish up a little bit on the market. I think for Noosa Labs as well as for SaaS Group, it's very clear that SaaS acquisitions are the lifeblood of our growth. I mean, we are a company that strives on M&A and on growing through acquisitions. But maybe, if you also put your founder head on, you've been in many companies, also your angel investor head. If there's a lot of founders listening again, and they're also very interested at some point, yes, they want to sell their company, but they're also still trying to grow their company, and I would love to hear your perspective on how acquisitions can be a growth opportunity for SaaS company with add-on acquisitions, or other sorts of acquisitions, technical acqui-hires, whatnot. Is like, what have you seen there? Maybe an interesting case you've learned on how acquisitions really can also be a tool which a SaaS founder should master. Any
Yeah.
insight there?
I mean, so I have a few thoughts on what you just said. I think that broadly speaking, the reason why people sell, at least to us at Noosa Labs, is because they've hit a wall, and they realize that they brought the company to a stage, and that they're hindering the next stage of their company. And in many ways, my job when I'm assessing a company is to figure out what skill set the founder doesn't have that we can bring to the table that will bring the company to the next level. And that's really one of my biggest jobs. If I can't find that, if I don't find that we have something to bring to a table, then I know that even though it might be a good business, we are not the good buyer for that business, because we will not do necessarily much better than them. And so I think that many founders, they're very proud of what they've built. It's part of their identity sometimes even. And so what they want is to maintain their legacy, and their legacy is their product. And so we care about that. We invest in product development. We continue building the product. And the best acquisitions we've made are the ones where we kept a relationship with a buyer, even though the seller, even though the seller is doing some other things, we're in contact with them and very excited to learn of what we've done, whether it's a major product redesign or a pricing change or a new enterprise offering, whatever it is that we're doing, we're trying to bring their product to the next level, and doing things that he or she was not able to do on his or her own. So that's one aspect. The second aspect, I would say, that I've seen, and not necessarily for Noosa, but we've looked at it, is that sometimes you have people that have a very good product but no distribution. And
Right.
obviously, if it's a product that complements what we have, so it's selling to the same buyer, etc., we can, because we have, for some of our businesses, thousands of customers, tens of thousands of free of users, I would say, of a product, we know that we can sell it to them and have their product used by other people, and that's what people want. When you're building it, when you're a builder, what you care about is also that your product is used because you're proud of it. It's it feels good about you feel good about it, and so we've looked at acquisition. We have never pulled the trigger yet, but we are I mean, we've been close in two instances where we wanted to buy a product because it was really a good complement to what we were selling already. And that's something that we want to develop more and more as we grow. And then,
That's certainly the trade a lot of founders should probably keep an open mind to as well, because it's most of the builders. I agree with what you're saying. Is most of the builders, they seem to just think about, okay, I have to invent it, I have to do it, but the fact that they can acquire something as a tag on acquisition usually doesn't occur to them, and
yeah,
needs of course that mindset. Cool. Yeah, so let's maybe wrap this up by a quick last outlook on the state of M&A in this year. It's probably also a topic we could talk on for hours. You've been in the
yeah.
market for a long time. You've seen a lot of things, but what strikes you about this particular year in terms of valuation, also the craze around artificial intelligence, the flood on the tool of this is like, how do you see how do you see the market or any of the specialities of the market this year compared to many of the other years
Yeah.
before?
So I would say there are three things that are happening at the same time. The first one is that the sellers who decide to sell have settled or have integrated the fact that the multiple that they're going to command are lower than they
Mm.
thought 2 or 3 years ago. And so the ones who are selling have integrated that concept and are okay with it. So that's number one. The second thing is that there's a lot of people still that are sitting on the sidelines or that are playing, that are flirting with the idea of selling. But the reality is that they have price expectations of 2 or 3 years ago, and they're just hoping that 2020, 2021 is going to come back, and they're going to be, they're hedging against that. And so they want to be sold for 5x ARR, 6x ARR for a product that may have some good growth and good retention, but it's not Twilio, right? It's not like if it's not Shopify, this is not like a major or Workday or something like that. Like if I'm buying Workday, I'm paying a high multiple, but I'm buying something with incredibly high LTV, like very durable revenue. Like if you're selling a small dev tools or CRM product or agency product or whatever, it's what you're doing is meaningful, but things can change,
Right.
and the AI world is actually shifting that world even more because many white collar work is going to change in the next 5 to 10 years, and nobody knows what is going to change. And so AI for me is shifting what the risk I'm willing to take a lot differently than 2 or 3 years ago, because I need one thing that I realized is that I need to be able to see 4 years of growth after the acquisition. If I'm afraid what the situation will be 4 or 5 years from now, then I know that it won't be a good acquisition for me financially. Because again, because of the way we buy, the fact that there's a loan, so first few years we don't take all the profits our way, and so we need to be able to repay the loan or part of the loan before, even if at the end it kind of tails off and then it goes a little bit down, maybe because it happens, it's a law of gravity of many software businesses. Well, at least we have skimmed some of the good years and we're not just straight into the downfall.
The loss, yeah. And it's, I mean, the question you used that at the beginning, that the realized valuation changes over the last 2 3 years. They're sometimes not so sure because the AI, of course, is also a big boom, and I agree with what you're saying. Is that AI is also a risk because it shifts entire industries. So it might be that the phase of growth and cash for the next 4 years isn't there, and that is a fundamental risk. And I think a lot of founders, they have not been through downturns. Many are first-time founders, and what I'm always seeing is they think like something has gone up for 3 years, they automatically think it will go up another 3 years, and that's just not the case. And I've seen SaaS founders even that brutally had a full stop at some point because some seismic shift in the industry, and then as a founder, you have all your eggs in one basket, and you're
Yeah.
basically left with nothing. And I think for us, it's okay for you as well because we have a portfolio approach. But that you have to factor in, and it's not like that. That's always linear, and I'm not sure always how people have really realized that in their.
Yeah, I agree, and I think that if you look at AI, which is the last trend, my third point, I think that AI obviously is an opportunity, and we've seen the third thing we've seen all in the market, especially at I would say even more at your revenue range, is you have these companies that are 1 year old that are doing 1, 2, 3, 4 million in ARR that didn't exist a year ago, and that grew incredibly fast and built like a SEO AI stuff or whatever. And I'm very very wary of these opportunities. I am, because what I do know at, and I know checker the company that I worked at before when I joined was before between the moment I joined and the year after, we grew 40x our revenue. Okay,
Wow.
and
Wow.
so and it's not me; it's just the market. I mean, I helped, but frankly, we had an amazing market opportunity. And what I've seen is that it takes a lot of effort and energy and resources to consolidate your growth, because when you're growing incredibly fast, what goes up fast can go down as fast. Um, and so the only way to make it durable is to build a lot of infrastructure, and the infrastructure costs are not baked into the price, because even if you're looking at multiple and you grew from 0 to 4 million in ARR in 2 years, maybe you don't have any costs. But the reality is that if you want to maintain that revenue in the long run, you have to build customer success teams and enterprise features and all that stuff. And this 90% gross margin or net margin business is becoming a 40% or 20% net margin business to be able to sustain itself. And so I'm very wary of that. And I would say I'm not a gambler. I mean, I have a gambling addiction on the angel side, and I treat it that way. But
I
Noosa
think
Labs,
it should only be a pocket, a small pocket, and I think I'm
yeah,
sure it is for you, of one's net worth, because that's the gambling part. You can gamble with a little bit, and it's fun, but yeah, it shouldn't be considered a business.
yeah, yeah, yeah. Yeah, my main business, I want it to be a bit safer and more long term, more durable. And so, yeah, I tend to not make these bets because you never know.
Maybe it's also something which comes with age. I mean, we're both probably somewhere in our in 40s or something,
Yeah,
probably. And as a founder, you take other risks, and I think that's okay. I always tell people the best time to start a company is really right after studies. You can live on minimum money. You have no family to feed, no car, no house, whatever.
yeah,
It's harder to start something later. You can take other risks, and then over time you appreciate the portfolio approach. You can see certain patterns, so I think maybe there's a reason that we're both doing somewhat similar businesses at the end of the day.
yeah,
After angel, after operative companies, and so also things. So yeah, very cool to have virtually met you. I hope I will also meet you in Paris, maybe as big little sort of advertising B2B Rocks, the conference. I'm sure you'll be there as well.
yeah,
This last conference in Paris in um, in September. Fun fact: it's actually now a sister company of saas Group because it's owned by Softonic, which is in turn owned by IO, which is again a company I'm very closely involved in, and so we're yeah, we've actually quite a few people coming to B2B Rocks. Dirk will be coming with me, Anna, the real podcast host here, and myself, and I hope to meet you in person then. And of course, also many of the founders and listeners, might be some tuning in from France here as well, given both of our networks. Yeah, and I hope people really took some interesting thoughts out there from two serial acquirers here.
thank you very much.
Thank you. And other than that, I really hope we're playing France in the semifinals.
Yeah, yeah,
Germany coming up against Spain tonight, Portugal,
For
France
France, yeah,
tomorrow,
yeah.
right?
No, tonight. It's also tonight. Yeah, you're playing
Also
at
tonight.
six.
Okay.
You're playing at six
Okay.
p.m. We're playing at 9
Okay.
p.m.
So fingers crossed. I think it's looking better for France, the statistics, but we'll see. Maybe we
We'll
have
see.
a semi-final here in Dortmund, which is very close to my place.
Okay, cool.
And yeah, with that, thanks for the podcast,
Thank you.
and I would
See you. See
say,
you soon.
yeah, see you soon.